Could you tell if a 4-year-old will be successful? Or if a rookie soccer player will play for the national team? Or if a newly married couple will stay together forever? I certainly can't. But a big part of my job is to conclude if a new startup will be the next billion-dollar company.
Startups are the seedlings of the business world. They are grown in nurseries called accelerators or incubators or angel funds. How would one go about knowing a seedling's future, health, size, or harvest?
What if assessing this seedling's future was the law? What if people's livelihoods depended on getting this right? What if, done incorrectly, it could cost millions in shareholder penalties? Let's see how a 409A valuation works.
Hi, I'm Bharat Kanodia. I have signed off on over 900 409A valuations, including Roku, Marketo, and Twitter. I tell founders what their companies are worth. Prior to 2005, companies were giving employees stock options while not being on the hook for paying taxes on them. IRC 409A was implemented in 2005. The IRS wanted to ensure they take their fair share of taxes of the non-cash component of employee compensation from Silicon Valley growth companies.
Think about it. Startups never have any profit, and they're lucky if they have revenue or product. Yet, they need to attract customers, investors, and employees. How? They do that using a currency called valuations.
Startups do not have the traditional metrics valuation experts use for valuing a company. Evaluators, after prolonged deliberation, have formulated innovative ways for valuing startups.
There are 3 ways of valuing a startup. 1. Assuming the startup has revenue and cash flow metrics, we can use a market approach or a discounted cash flow, the traditional ways of valuations. But since 98% of the startups are not profitable, we have to use the revenue metrics in the market approach. For example, if the company's revenue is 5 million and the peer or comparable companies are trading for 8x, then the company's value could be about 40 million, 8x times 5 million.
2. A company is worth whatever someone is willing to pay for it. This valuation method is based on the company's last round of funding. So if someone paid 20 million for the last capital raise, so long as that round is within 6 months, we can argue that that valuation is the best benchmark.
3. If the company does not have revenue or has never raised capital, then valuing it is like valuing an art collection from an unknown artist who has never sold anything. The artist, like the founder, is unknown without a track record. The art collection without any following or without any history of transactions is like a company without revenue or a history of capital raise. So how would you value art or a company with so many unknowns?
It is difficult to find peer startups who are in the same industry, same business model, and in the same location. In such cases, we showcase the company to an angel investor who invests in comparable companies to get her input. We also compile data from PitchBook and other databases and create a virtual marketplace to support our valuation conclusions.
This, however, is only the halfway point. Once we determine the value of the entire enterprise, we have to allocate that value into different classes of stock because each class of stock has different terms, conditions, and ownership rights. Just as crude oil is refined into different products to cater to different demands. Frankly, determining the value of the company is fairly straightforward compared to the allocation of that value into different classes of stock. A wise valuator knows that the allocation piece is the Achilles' heel in a 49A valuation. As Mark Twain said, get your facts straight first, and then you can distort them as you please. Thanks for watching.